Common investor mistakes in using PE ratio. Imagine this. You are looking at a stock with a PE ratio of 5. It looks insanely cheap, so you buy it. But then the stock keeps falling. And you wonder, what went wrong? In this video, we will uncover why PE alone is useless without context and how understanding the full picture can help you avoid common pitfalls. What is PE ratio? Alright, let's start simple. The price to earning ratio, or PE, is one of the most commonly used tools in investing. It tells you how much investors are willing to pay for $1 of a company's earnings. The formula? Super basic. Just take the stock price and divide it by the earnings per share. So, if a stock is trading at $100 and it earns $5 per share, its PE is 20. That means investors are paying $20 for every dollar of annual profit. Sounds straightforward, right? And that's exactly why it's so popular. It's quick, it's easy, and you can find it on almost every finance website or stock screener. Some even use it to compare two companies or to decide whether a stock is cheap or expensive. But here's the thing. Simple doesn't always mean accurate. The PE ratio can be helpful if you know what you are looking at. But if you take it at face value, it can be wildly misleading. Why? Because not all earnings are created equal, and not every $1 of profit today will be worth the same tomorrow. In the next few minutes, we will break down the 3 biggest mistakes investors make when using PE and how to avoid them. One low PE is actually dangerous. So here's where things start to get interesting. Not all low PE ratios are created equal. Sometimes a stock has a low PE because it's genuinely undervalued. Other times it's low for a reason, and that reason could sink the stock even further. Let me show you both sides. Example 1, the legit low PE. Back in 2022, a small cap insurance company was trading at a PE of just 7. Earnings were stable, the company had no debt, and it was sitting on a pile of cash. The reason it was cheap? Investors were not paying attention. It wasn't exciting, no buzzwords like AI or cloud computing. But a year later, the stock was up nearly 60%, with earnings growing steadily. In that case, low PE was a real opportunity, a classic case of the market sleeping on boring fundamentals. The value trap. Now on the flip side, let's talk about the global auto manufacturer in 2019. It had a PE of just 5, looked like a screaming bargain. But behind the scenes, profits were already declining, margins were shrinking, and the industry was heading straight into an EV disruption they were not ready for. A year later, the stock dropped 40%. So that low PE, it wasn't a discount, it was a warning. Earnings quality matters more than PE ratio. Here's another common mistake, assuming that all earnings are real, stable, and recurring. But they are not. The E in PE comes from net income, and net income can be messy. Sometimes earnings are inflated by one-time gains, like selling of assets or tax credits. Other times, earnings are high because the company slashed R&D or marketing, which is look good short-term but hurts growth long-term. That means your cheap PE might be based on earnings that won't even exist next year. Here's the real example. In 2021, a media company posted record earnings. Their PE dropped to under 6. But if you look closer, over 40% of that income came from selling intellectual property, not from operations, not from subscribers, just a one-off transaction. The market didn't buy it, neither should you. Here are the bonus red flag. Watch out for companies with wildly swinging earnings. Commodity stocks, for example, like oil or steel, can look extremely cheap at the top of the cycle. But that's exactly when earnings are most vulnerable to collapse. So the PE looks cheap right before the E disappears. A low PE on fake or fragile earnings isn't a value, it's a trap. Before trusting the ratio, always ask yourself, where are these earnings come from? And can they last? Why a high PE doesn't always mean overpriced. Now let's flip the script. A high PE doesn't always mean a stock is expensive. In fact, sometimes it's the opposite. It reflects quality, growth, and consistency. See, PE is not just about price. It's also about what kind of earnings we are talking about and where those earnings are headed. Extended growth price example, Amazon in 2014. Let's dig deeper into Amazon back in 2014. The PE ratio over 100. For most investors, that's an instant red flag. But here's what many miss. Amazon wasn't optimizing for earnings. It was optimizing for scale. The company was pouring cash into infrastructure, warehouses, logistics, cloud computing, and content. On the surface, it looked like they were barely profitable, but under the hood, operating cash flow was exploding. Breakdown insight. If you strip out the aggressive reinvestment, Amazon was already highly profitable. AWS, their cloud division, was growing over 40% per year with margins above 20%. And the e-commerce engine, while low margin, was locking in a customer behavior for life. So, is that high PE? It wasn't a bug. It was the market pricing in a future where Amazon would dominate multiple verticals, retail, cloud, even advertising. The payoff? Fast forward just 5 years, AWS became a $30+ billion business. Operating leverage kicked in, net income skyrocketed, and shareholders who looked beyond the high PE saw their investment 5 times or more. Lesson? Sometimes a high PE isn't irrational, it's visionary. The real mistake is confusing expensive on paper with overvalued in reality. Now let's talk about different kind of high PE, the kind that comes from stability and quality. Look at Procter & Gamble. The company rarely trades below a PE of 20. In fact, during some periods, the PE hits 25 or even 30. And yet, investors still keep buying. Why? Because what you are paying for isn't just for earnings. You are paying for predictability, cash flow resilience, and brand power. P&G owns household brands that are basically staples of daily life. Tide, Pampers, Gillette, Pantene, Oral-B. These are products people buy regardless of inflation, recession, or interest rate changes. That gives P&G strong pricing power, low earnings volatility, and a customer base that rarely switches. During downturns, when cyclical stocks collapse, P&G tends to hold steady. The revenue doesn't spike, but it doesn't crash either. Dividend payout stays safe. Debt remains manageable. In a chaotic market, that kind of consistency is a premium product, and the PE reflects that. So, if you are looking at P&G and thinking, why would I pay 24 times earnings for a boring sub company? The answer is simple. Because boring is beautiful when it's predictable, profitable, and proven. High PE doesn't just mean high expectation. Sometimes it means high reliability. And for some investors, especially in uncertain times, that's worth every penny. Conclusion: PE is just the beginning, not the end. So here's the bottom line. PE ratio is not a valuation tool, it's a valuation hint. On its own, it tells you almost nothing. Without knowing the quality of the earnings, without understanding the company cycle or future growth or risk profile, PE is just a number. Cheap can be dangerous, expensive can be justified. The real work is asking, why is this company valued the way it is? What's behind the E? Is it fragile? Is it cyclical? Is it manipulated? And more importantly, what does the market already know? And what's it missing? Smart investing isn't about finding low PE stocks. It's about finding mispriced reality. And reality is always more complicated than a single number. So, next time someone says, this stock is cheap, the PE is only 7, you'll know to ask, cheap compared to what? And whether those earnings are even real. Keep questioning the obvious. That's how you get ahead in this market. If you found this breakdown useful, hit like, subscribe, and let me know in the comments. I'll see you in the next one.